Hey guys, Lincoln here. Today, let's talk about the initial public offering, what it is, why it exists, and how companies use it to take their private company to the public markets to sell their shares to public investors like you and I. So what is an IPO? What is an initial public offering? An initial public offering is exactly what it sounds like. A company decides that they need to raise more funds and that they want to do that from the public market. So because this is the very first time they've done this, they're going to do it for the initial time, the first time ever. So they take their shares and they say, hey, public investors, we're here. This is our company. We're doing this well and we want to grow our business and we need more money from people like you, from investors like you, to help us get to our mission. So you can now buy shares of our company so that you own a portion of our success. If we do well, the price of your shares will go up, and if we do poorly, the price of your shares will go down. We believe that we're going to continue to execute well and grow this company to a very large and successful enterprise in the future. So we hope that you will buy our shares and stick with us for the long run. That's all it is. They are offering shares of their company to the public for the first time, for the initial time, and that's why it's called the initial public offering. So how does the initial public offering process work? They can't just decide today that they want to be a public company and then tomorrow be listed on the public stock exchanges. They have to go through a lengthy process that's very expensive. So let's take a look at exactly how the process works and what it takes to become a public company. So a little bit of background. When a company starts, they have to raise money from friends and family, from small investors in the private market to fund their operations in the beginning. And as they go on and they continue to do well and they grow, they have to continue to raise funds if they aren't making enough money from their operations, from their business, to continue their growth. So if they need to accelerate their growth, they're going to go out there to private investors, to angels, to venture capitalists with big pockets, lots of money to invest in young companies and say, hey, this is our company, we're doing well, but we need more money to continue to grow. So we're asking you for $100,000, $1 million for shares of our private company. They continue to do this over and over again over the years as they grow and grow. But at some point, they exhaust their options, right? They have grown too big and the cost of their shares on the private market is way too expensive for private investors. The angel investors, the venture capitalists can no longer afford to continue to fund this private company's growth. So the early investors in the company decides that the company needs to go to the public market in order to raise more funds. So once the company decides that they want to go public, that they want to become a publicly listed company, they start to market themselves to investment bankers who will be their underwriters in the deal, in the process of going public. So before we continue, let's cover what an underwriter is because they are a very important part of this IPO process. An underwriter is simply someone or some party that assumes all or part of the risk of selling the private company's shares to institutional and public investors. The underwriter guarantees the sale of the shares of the company by buying up those shares of the company at a discount, hoping to profit from the sale of those same shares to institutional and public investors later on through the IPO process. So once an underwriter is chosen by the company and they both agree on the terms of the deal of the IPO process, the underwriter's job now is to go out there onto what they call a roadshow and market the deal to institutional investors and determine what a good price will be for the public market. And at the start of this process, the company must choose which stock exchange they want to be listed on, which public stock exchange, right? The New York Stock Exchange or the NASDAQ. They have to choose one of those in order to be listed publicly. And once they choose the stock exchange that they want to target, the company must now meet all the regulations of that stock exchange as well as government regulations, right? Set by the SEC, the Securities Exchange Commission. in order to successfully go public. This process is very slow, and it can take a year or even more, but it helps the company mature and gets them ready to continue to abide by stringent regulations that are placed on public companies. So once the company meets the regulations of the stock exchange and the SEC, and the underwriter has secured early funds from institutional investors, a IPO date is now set for the company to actually go public. When that IPO date comes, the company is officially listed on the public stock exchange, and public investors like you and I, retail investors, institutional investors, can now participate in the buying and selling of the shares of the now public company. So this is the big moment they've been working up to for a year. So that's the IPO process in a nutshell. Right, of course, there's more details that I've left out because on this channel, I want to make it as simple as possible to understand these complicated concepts so that you can get started investing with the knowledge you need to do so without the extra jargon. So the company is now public. They're listed on the stock exchange. They've met the regulations of the SEC. So can they continue to raise funds from the public using this same method? Yes, they can continue to issue more shares to the public investors as they need to raise more funds in the future. So when a company sees that their stock price has reached a certain level and that there is more demand for their company at this time, they might decide that, hey, this is a great time to raise more funds from the public. So they will issue more shares to the public through a follow-up offering, right? This is the same as the initial offering, just that it's a follow-up. It's not the first. So they will issue more shares to the public at the current stock price or lower so that they can raise more funds for the company. So they can do this as many times as they want, but they have to be careful not to dilute the shares of the existing investors too much, because when they introduce more shares onto the market, they're creating more supply, which means that the value of the existing shares decrease, right? It's the same idea as inflation. As there is more money put into the market, into the economy, the value of each dollar decreases, right? So this happens over time, and this is natural. But the company has to make sure not to do it too often. Otherwise, they will continuously put downward pressure on their stock price and keep it from appreciating as investors expect it to. So if you look at a company's stock price over time, you can probably see when they undergo a follow-up offering and they issue more shares onto the market, because you can see that their stock price takes a huge fall. Temporarily, of course, right? Eventually, the stock price should go back up if the company continues to meet and exceed expectations of the public investors. So that's what an IPO is. That's what an initial public offering is. A private company decides that they need to raise more funds and that they want to do it from the public market so that they can become a publicly traded company. So they offer their shares to the public investors for the first time, and from then on, their stock is traded on a stock exchange, which means that the price of their shares can go up and down, raising and decreasing the value of the company. This is the market capitalization, right? The price of the shares of the company multiplied by the number of shares outstanding. So the company wants to continue to grow this number and continue to increase their market cap, because that is the perceived value of their company on the public market. So as that market cap continues to grow, that shows how valuable the company is and how much your share of the company is actually worth, right? The price of the stock is arbitrary. The company can issue more shares or split their shares. The price of the stock is not what matters. It's the market cap that matters. How valuable is this company and how many shares of that company do you have? That determines the value of your position in a company. So you want to see the market cap of the company continue to grow over time after their IPO. So I hope that I've clarified for you what an IPO is, how it works, and why companies undergo this lengthy and costly process in order to become a public company. So thank you for watching this video, and if you enjoyed it and you learned something new today, please remember to like this video subscribe to the channel in order to help more investors discover this channel and learn how to invest in the stock market. On this channel, we want to help more people learn how to invest in stocks and practice the bull mentality, right? The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term so that we can see the appreciation in the value of our investments, right? That is how you build wealth in this country, and that is how you build financial independence. So thank you again, and I hope to see you next time. Have a great day.